Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about Open. Open Door Technologies Inc. has been, it's been the defining volatility trade of late 2025. This is a stock that traveled from the absolute brink of oblivion. I mean, we're talking lows around 50 cents in the middle of the year when it was facing a mandatory delisting threat, to staging a spectacular near six-fold recovery. It's now holding firmly above the $7 mark by December. The sheer speed and scale of this turnaround, it transforms Open into one of the most critical and frankly confounding battlegrounds in the public markets right now.
It really does. And that dramatic price action, from near zero to hero, it absolutely demands a deep, skeptical look under the hood, particularly at the financial plumbing. What is most fascinating to me is that even as the price soared, the underlying market structure data remained bizarrely consistent. We saw consistently elevated off-exchange short volume ratios, perpetually hovering between 30 and 38%?
Right.
I mean, we can just look at December 5th, where over 10.3 million shares of short volume were executed in dark pools out of about 28.8 million total volume. This suggests massive, systematic institutional counterselling right into the rally.
And that tension, that exact tension between what looks like operational success and this technical resistance, that brings us to our core disagreement today. My position is that this massive recovery is a sustainable validation of a dramatic governance and strategic shift, what they're calling the move to founder mode, and that, investor conviction is finally being rewarded because the fundamentals are genuinely improving.
And while I respect that narrative shift, I'm going to contend that the speed and the magnitude of this six-fold rise are primarily the result of sophisticated and I would say deliberate financial engineering. It was designed not just to raise capital, but specifically to force a painful, structural short squeeze on established bearish positions. The technical tail is wagging the fundamental dog here, at least for now.
Well, let's pivot back to those fundamentals, because what I see happening is a genuine governance revolution that created the necessary backdrop for this recovery. Bringing back co-founders Eric Wu and Keith Rabois and appointing Kaz Najatian as CEO wasn't just, shuffling names around. It signaled a decisive, necessary operational pivot away from the disastrous, capital-heavy iBuying model that nearly killed the company in the first place. The old Open Door acted like a highly leveraged real estate speculator, vulnerable to every single interest rate hike. The new leadership immediately signaled a move toward an asset-light strategy. This is critical. They are de-emphasizing holding inventory and instead leveraging their proprietary software and AI to push sales through partnership channels. They want to act as the market maker and service provider, taking lower risk fees rather than retaining the primary balance sheet risk.
They are laser-focused on using AI to drive down the cost per transaction and optimizing pricing. This is a structural change, not just a cyclical one. And perhaps the ultimate expression of management conviction came in August 2025, the cancellation of the proposed 1-for-50 reverse split. I mean, that was a high-stakes move. They voluntarily removed the existential threat of delisting by believing they could achieve organic price recovery, and that proved to both institutional and retail investors that the management team saw a viable path forward. When you combine that conviction with the CEO himself purchasing 125,000 shares in December, you have a solid, evidence-based fundamental thesis.
That's an undeniably compelling narrative of rebirth. I'll give you that. But the historical data, it just strongly suggests that the extraordinary speed of this rally is better explained by the deliberate structural squeeze on bearish positioning rather than, gradually improving unit economics. The acceleration we saw in November is directly attributable to the special dividend of tradable warrants, the Series K, A, and Z series that were issued that month. For our listeners who may not deal with these instruments every day, a warrant is essentially a long-term option issued by the company itself, giving the holder the right to buy stock at a fixed price later. By attaching 3 separate series of these tradable warrants to the common stock, the company created an immediate and frankly weaponized logistical headache for short sellers. If you were short 100 shares of Open, you were suddenly also obligated to deliver 100 shares of the K, A, and Z warrants. This liability multiplier made holding any short position exponentially more complicated, expensive, and risky to maintain. This forced capitulation. It had to. Short sellers had to cover an estimated 36 million shares before the November 18th record date simply to avoid the obligation. And we see the resulting market stress confirmed by the severe spike in FTDs fails to deliver, which are unsettled trades signaling extreme stress in the lending market. FTDs jumped to over 5 million shares on November 12th. This wasn't fundamental demand driving the price. It was forced structural de-risking and buying just to settle obligations. The cash infusion of up to $1.27 billion, while beneficial, is generated by maximizing volatility and forcing that capitulation.
I fully agree the warrants were a brilliant tactical move, the piece of financial judo, if you will, but they were a catalyst. They were a catalyst enabling the fundamental shift, not substituting for it. A technical move like that only works if there is a fundamental story underneath to catch the price and hold it. And the actions of the new leadership team demonstrate genuine operational discipline that provides that backbone. We're not just talking about staff cuts, we're talking about targeting financial sustainability. They are now guiding toward adjusted net income break-even by late 2026. This isn't some vague aspiration. This is a measurable target for operational stability. Furthermore, look at Q3 2025 revenue. It came in at $915 million, which beat expectations, despite the heavy inventory pullback, which is a necessary part of this asset-light shift. The engine is running cleaner and stabilizing. You can't squeeze a dead stock sixfold unless it's already demonstrating clear, tangible signs of recovery that long-term investors can actually price in.
I'm sorry, but I just don't buy that the operational turnaround has fundamentally changed the underlying economics enough yet to justify the current $7 plus valuation. The reality is that much of the rally is built upon one massive macro factor: forward pricing the housing market thaw. The hope is that the Federal Reserve rate cuts will materialize soon, allowing mortgage rates to drop significantly, perhaps falling toward, 6.39%. That is a bet on global monetary policy, not a micro success on unit economics. If the Fed delays, that fundamental pillar of your thesis cracks. Furthermore, let's talk about the retail component, the pure technical force. The core narrative is constantly fueled by powerful retail sentiment, viewing open as the next Carvana or the ultimate high-risk recovery play. They engage in massive YOLO trades driven by call options. And this forces market makers, the financial wholesalers on Wall Street, into what's called gamma hedging. To hedge against the liability of those call options being exercised, market makers are forced to buy the underlying stock. This generates non-fundamental buying pressure that artificially inflates the price and keeps it elevated far beyond what any serious institutional investor focused on 2026 break-even guidance would pay.
That's an interesting point about the mechanics of gamma, though. I would frame it differently. You're framing the high-risk appetite purely as speculative noise, when I believe it is a response to credible signaling from management. Consider the exercise prices of those warrants, $9, $13, and $17. These are not arbitrary numbers chosen at random. They are management's very public, very clear signaling of realistic, stepped valuation targets. They are communicating to the market where they believe the company should be trading within the next year to 18 months based on achieving those operational benchmarks we just talked about. And the market's reaction validates this belief system. The willingness of sophisticated players to pay up to 78 cents for the $17 strike OpenZ warrant indicates an extremely high conviction in a massive re-rating, technology peers, which is a giant leap up from its current valuation of less than half a time sales. This valuation signal proves the market is taking the AI and asset-light pivot seriously.
I see why you think that, and I agree the $9, $13, and $17 strikes are powerful psychological targets. But let me give you a different perspective on that trigger mechanism. While the successful exercise of these warrants provides a potential cash influx, which, again, is vital for a company that continues to burn cash, they simultaneously create a massive potential dilution overhang. The company has registered nearly 100 million shares to cover these warrants. That $10.80 early trigger price for the Series K, for example, might force warrant holders to exercise, providing that immediate cash injection. Sure. But that action simultaneously floods the market with new equity supply. The cash is necessary precisely because Opendoor remains structurally dependent on the whims of the Federal Reserve and the housing market. The warrant structure merely transforms the volatility, which was initiated by technical short covering, into an inevitable risk of massive future share dilution. It's a mechanism leveraging market desperation for short-term survival.
Focusing back on investor confidence, I believe the return of founders Rabios and Wu provided an essential layer of institutional credibility that helped counteract the sustained short narrative, regardless of the warrants. Rabios is a known quantity in Silicon Valley. His involvement signals serious intent regarding the AI strategy. But more importantly, the cancellation of the reverse split, driven partly by activist pushback, was the crucial psychological inflection point for every type of investor. It proved the recovery was organic, demonstrating management's sustained confidence. I mean, consider OfferPad, a key competitor, which did execute a reverse split. It was perceived as a desperate move that resulted in continued institutional selling. Opendoor avoiding that move entirely was a massive, non-technical victory that gave credence to the fundamental turnaround story.
I'm not convinced by that line of reasoning, because the microstructure data keeps contradicting the organic recovery narrative. The persistent high dark pool trading volume, that 30 to 38% off-exchange short ratio, strongly suggest institutional market makers are actively dampening upward price momentum. Let's clarify how this works. They internalize large blocks of retail buy orders in the dark pools, essentially executing the buy order but immediately selling shares short off-exchange to hedge their exposure. They are systematically providing equity supply to counteract every strong move up. So the upward price pressure, that coiled spring effect, it has to come from technical necessity. It has to be market makers being forced to buy stock to balance their books, or the fails to deliver forcing buy-ins.
Sustained fundamental investor demand that believes a $17 target is imminent.
Ultimately, we've established two powerful yet competing explanations for the resurrection of Opendoor. On one side, I've detailed the story of a genuine structural rebirth, the founder mode strategy, the deep operational cuts, and yes, the tailwind from the macro housing thaw, which collectively provided the necessary ingredients to pull the company back from near death.
And I have argued that this dramatic price action was heavily engineered, first by forcing short sellers to cover due to the warrant liability, and second by leveraging market microstructure and intense retail sentiment that could create a non-fundamental buying pressure. The stock is trading as a volatility vehicle, pricing in an aggressive recovery path signaled by management's strategic $9, $13, and $17 strike prices.
Right. And the critical divergence point remains whether the company's operating fundamentals, the successful execution of the asset-light model, and the AI pivot can accelerate fast enough throughout 2026 to genuinely catch up to the current technical valuation being dictated by these powerful financial instruments.
Exactly. Opendoor has survived its immediate crisis, transforming into a volatility machine fueled by the promise of future capital. Its long-term viability hinges on whether the potential $1.27 billion in capital infusion becomes genuinely accretive to its business model or merely represents massive future share dilution required for survival. The stock is currently functioning as both a macro derivative and a high-leverage bet on future tech execution.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.